Hello friends, so let us continue discussing the ICAI study material questions from the chapter Forex exposure and risk management. See, take question number 6 for discussion. JKL Limited, an Indian company, has an export exposure of Japanese yen 10 lakhs, 10 million receivable on August 31st, 2014. Japanese yen is not directly quoted against Indian rupee. The current spot rate are INR per US dollar given, Japanese yen per US dollar given. This is current spot rate as on today. Okay, date not mentioned, but today the maturity date is 31st August. Okay, receivable say after 1 month, assume today is July 31st. So this is current spot rate now as of today. Right, it is estimated that Japanese yen will depreciate to 124 level and Indian rupee will depreciate to 65 level against US dollar, which means the quotation given for US dollar, INR per US dollar 62.22, it is estimated, forecasted that on the date of maturity, it might be depreciating to 124, which means 102.34 is there now, that might depreciate to 124 is what is the company estimating. Next, and the US dollar is depreciating to 65. $1 is equal to 65. Right. Forward rates for August are given, which means this is today 31st July, assume 1 month. Okay, the forward rates are quoted in the market as follows. INR per US dollar given, this is forward rate quoted today itself. Okay, required, calculate the expected loss if the hedging is not done. First option, okay, first part what they are asking, see, calculate the expected loss if hedging is not at all done, which means you will compare with current spot rate and okay, the estimated spot rate, which means initially it estimates that on the date of maturity this will be the spot price now. So on the date of maturity, whatever is the spot price, compare with the spot price quoted today and find the profit or loss. Okay, this is what they are asking. Expected loss they are straight away given. How much is to be computed if the hedging is not done. Next, how the position will change if the firm takes forward cover. Next segment, the first part, in the same part, they are asking in the next segment, okay, what will be the, how the position will change, which means the profit will change, loss will change. Okay, whether it is profit or loss, we need to compute, and it will change if you take forward cover, if you take the forward cover. Forward quotation given in this part. Okay, are you understanding? So this forward cover you will compare with, okay, current spot rate, and then whatever is the loss or gain, you will then this loss or gain you will compare with the already computed estimated loss or gain as per the estimated spot price. See, there are three things here. One, there is current spot quotation given, and there is also estimated detail about estimated spot on the date of maturity given. And the third thing is they have also given the forward rates which is quoted today. Are you all understanding? Three things are given. First option, no hedging at all is done. Then what will be the expected loss, which means estimated amount will there now. It is going to depreciate, you are expecting that you will compare with current spot rate and find the differential amount. Are you all understanding? Loss. Then forward cover you will compare with the current spot rate, and then you will find loss or gain, and that you will compare with the previous segment, and then find out whether the forward is actually beneficial or not. Are you understanding? Next, if the spot rate on August 31 are this much, is the decision to take forward cover still justified, is what is the question asking, which means already you have taken forward cover, but earlier you compared with the estimated number. This is just estimation. Really on the date of maturity, spot price could be something different, right? Here what they have given, assume on 31st August this is the spot price, what would be the gain or loss. So all the situation given we will try to compute. Shall we see question number 6 here? Okay, but in this question, important observation, yes, these things are to be computed, but the problem is, what is the problem now? See, this is an export oriented company, and it will have Japanese yen 10 million receivable. Okay, but it is not directly quoted against Indian rupee, which means, see, what we want now, rupee per yen is what we require. Either rupee per yen is available or not available. Sorry. See, INR per dollar is given, Japanese yen per dollar is given, but rupee per dollar is not given. What you should do in simple terms, see, very simple. You have Japanese 10 million receivable, which means, okay, tomorrow I will export oriented business, receivable. Tomorrow I will sell yen, buy yen, sell yen. Apo I will sell the yen, correct? I will sell this yen and buy dollar and sell the dollar and convert it to rupee, as there is no direct quote available for rupee against yen against rupee. Are you all understanding what I am trying to say? So, which means yen you will sell and convert it to dollar. Okay, now this is yen, dollar per yen you need to find out. Now what will be the equation? Dollar per yen cross rate. Now common currency you will use and equate. Here common currency is what? US dollar is the common currency. So rupee per dollar into dollar per yen. This is what you need to compute. Rupee per dollar given, yes, directly given. INR per US dollar 62.22, which means if you sell, see in this question there is no bid and offer rate. In the next question we are going to see bid and offer rate as well, cross rate. Are you all understanding? Cross rate, where bid as well as offer rate is involved. How to compute that I will explain in the next question. Here you understand, rupee per yen is given to be found out and rupee per dollar given. Now there is no issue of bid and offer rate, directly take it the quote. 62.22, if you sell your yen you will get, if you see, yes, rupee per dollar is 62.22. This is there, but first you need to purchase yen, you need to sell yen, you will sell and purchase the dollar. So dollar per yen given quotation or yen per dollar given, yen per dollar given, which means the dollar per yen given, yen per dollar, yen per dollar. What you do? 1 divided by dollar per yen will give you yen by dollar, which means very simple, 1 by 102.34 will give you the dollar per yen. Are you all understanding? Yen per dollar given as 102.34, and to convert it into dollar per yen, simply 1 divided by 102. Effectively, okay, the cross rate rupee per yen will be nothing but 62.22 divided by 102.34. Are you all understanding? How much is that? Please tell me. Okay, 62.22 divided by 102.34. 0.6079, 6080, I can round it off, 0.6080, rounding off, okay, 4 decimal, I am rounding off. See, what happens here? Now, I need to sell yen, I will get it equivalent dollar, then sell dollar and get it rupee. Now, you have how much to sell? 10 million yen to sell. Are you all understanding? Now you see the solution, you will understand the cross rate, how you compute. See, the computation of cross rate they have given in the first step. See, rupee per yen is nothing but rupee per dollar into dollar per yen. You have computed 0.6080. Spot rate on the date of export. This I told you, 4 rates are given in the question. What are the 4 rates? Spot rate today, okay, spot rate. Then they have given estimated spot rate, which is estimated spot rate on the date of maturity, second one. Third rate is forward rate for 31st August quoted today. Are you listening? For second part, they have also given, okay, the revised estimated, the actual spot rate on the date of maturity. See, you estimated today what could be the spot rate as on 31st August. But really on 31st August, it need not be same. Yeah? It could be something different. That also they have given. Okay, the real spot rate on 31st August is also given. So all these 4 numbers are given. First, we will convert everything. Okay, all 4 are given, for different currencies. So common currency, use the common currency and convert it to cross rate first. For spot rate on the date of export, if you convert, this is the cross rate. This is the cross rate, which means rupee per yen is nothing but how much? Rupee per yen 0.6080. Next, expected rate, which is estimated rate. They have given that you will come to it. Okay, they told it will depreciate 124 level and the dollar will appreciate, which means Indian rupee will depreciate with respect to dollar. Okay, and 62.22 will become 65 per dollar. You apply that 65 by 124. Simply you did here 62.22 divided by 102.34. Same way here also you do and get the cross rate converted. Next, one more rate is there, forward rate. That also you convert 66.5. Here cross rate, forward rate 66.5 divided by 110.35. Same mechanism. Okay, once you found out what number to be divided, what number to be multiplied, then everything will be same. So here also 62.22 is substituted 66.5 divided by 110.35. Okay, you will get the forward rates. Okay, cross rate for the forward rate. See, now calculation of expected loss without hedging. First option, what is the question? Without hedging, what would be my expected loss? Value of export at the time of value of export at the time of export. Now, spot value of the real export value realization as per the spot rate is nothing but 60 lakhs 80,000, because 0.6080 is the rate na Japanese yen. If I convert to rupees, this will be my receivable amount. Now, estimated payment to be received. Okay, estimated receivable as per the the estimation. Today you are on 31st July, you are trying to estimate what could be the spot rate, okay, on 31st August, which means this 0.5242 estimated cross rate I will consider, and then find the realization value 52 lakhs 42,000, and this is the net loss, which means if you don't hedge, are you all understanding? If you don't hedge your exposure, you will be incurring loss of 8,38,000. You will compare this and 8,30,000. Assume hedging of loss under forward cover. What they have asked in the second part. See, if I don't hedge, this is the loss. If I hedge, what will be my loss or gain? I will compare, compute, and then I will compare with the first option. So what happens? Value of export at the time, this will remain same for all the option. 60 lakhs 80,000, spot rate will be same. Correct? Now, payment to be received under forward cover. If you enter into forward contract, what would be the amount? 60 lakhs 26,000. Hence, if you enter into forward contract, you will only incur loss to the extent of 54,000. Okay, if you leave the the exposure without hedging, okay, then you will incur loss of 8,38,000. There is a savings in loss now, which is obviously gain. So which is better? Forward cover is better. Are you all understanding? By taking forward cover, loss is reduced to 54,000, which is better. Okay, without hedging, better is to hedge the contract. Now, next part. Okay, first part stands solved. Part 2, if the spot rates on August to 31, 2014 are INR US dollar 66.25 SW converted, is the decision to take forward cover still justified? See what they are asking. They have given revised amount na. The revised actual rate, which is the real rate prevailing on 31st August, turned out to be 5977. Estimated some number, but really it turned out to be 5977. I need to compare. Yes, I will compare. Up 60 lakhs 80,000, which is as per the current spot rate, and I will compare the real actual spot rate on the date of maturity 5977. Realization as per maturity date spot price will be 5977. You tell me, children, loss or gain? Loss. How much is the loss? 1,03,000 is the loss. Now you tell me, what they are asking really is that, see, you estimated something and based on estimation you took forward cover. Now what they are asking, okay, if the real rate turned out to be this much and you also didn't take forward cover, whether still taking forward cover is justified or not. Up what you will compare? These numbers you will compare, and you incur a loss of 1,03,000, which is obviously, okay, still more than 54,000. If you take forward cover, you will incur only loss of 54,000. Okay, and irrespective of what the maturity date spot price, okay, you will make only loss of 54,000. Here you are incurring more loss, additional loss na. So it is still justified. The taking forward cover is still justified as per even the revised spot rate, which means they change the maturity date spot price na. Even as per the revised spot price, okay, still taking forward cover is justified. Take question number 7. Next, you sold Hong Kong dollar 1 crore value spot to your customer at 5.7 and covered yourself in London market on the same day, when the exchange rates were US dollar, Hong Kong dollar. Okay, Hong Kong dollar 7.88 hyphen 7.592. Here bid and offer rate is given. Very, very important. Bid and offer rate given, and direct quote is also not given. Cross rate you should consider, bid and offer as well as to be understood. So very good quality question. Mark it as important. Question number 7 and 8 are of good quality question. Okay, cover deal questions. I will explain also briefly the concept and we will move on. See, next, local interbank market rates for US dollar, where spot US dollar US $1 is equal to 42.7 and 42.85. Bid rate and offer rate given. Calculate cover rate and ascertain the profit or loss in the transaction. Ignore brokerage. This is a question that is being asked. Before trying to solve the question, you need to understand what covered deal does. See, covered deal, what do you mean by covered deal? See, what happens, you see, the bank in this question, I'll take this as example. In this question, what happened? You sold, assume you are a dealer. You should assume that whenever the cover a deal transaction, who will cover the deal? A dealer, okay, in Forex should cover the deal. Okay, the customer will not try to cover the deal. There will be no cover transactions. Are you understanding? Which means a dealer, I'll tell you what happens with the dealer. Briefly, I'll try to explain. See what happens. Okay, assume this is a, okay, account of the dealer. What he does generally, Abdina, see what happens. You sold Hong Kong dollar 100 lakhs, 100 lakhs, okay, HK dollar. He sold to the customer. Assume this is sold to the customer, na? Sold to customer. This side is customer side, transaction with customer. Okay, this is interbank transaction. Interbank transaction. To put it simply, what happens, I'll tell you. Okay, now you have assumed you have something very risky. See, very simple. This customer is export oriented. You sold Hong Kong dollar, na? The dealer is selling Hong Kong dollar, which means he will be buying Indian rupees. Are you all understanding? Okay, which means this this customer is exporter, importer. See, this customer is exporter, hence he would be, okay, he will be selling. Yes, this customer is importer. Assume there is an import customer. He would be having dollar payable, na? Foreign currency payable, Hong Kong dollar payable in the future, right? What he will do? He will buy the Hong Kong dollar from the dealer and make the payment. Are you understanding what I'm trying to say? Which means dealer will sell the Hong Kong dollar. See, dealer will sell the foreign currency to the customer, import customer. Now, when dealer is selling the Hong Kong dollar, from where you will sell? See, the problem is you have, see, I'll tell you what happens. Now, he has sold to the customer Hong Kong dollar. Now, the point is, say after 1 month, entered into forward contract, after 1 month, okay, this dealer has to sell 100 lakhs Hong Kong dollars to the customer. Assume. I am saying after 1 month because to make you understand how cover deal happens. Now, what he does, now, after 1 month, the dealer requires 100 lakhs Hong Kong dollar. Na? The point is, if he, okay, where he goes to Hong Kong dollar, he need to purchase. The dealer, na, he is just a broker. He will purchase from bigger market and then he will sell to the customer, which means the dealer, okay, dealer is only a facilitator of the transaction. He will buy the dollar, sell the dollar. This is what he does. Now, he deals with the Forex. Now, the point is, when you want to sell 100 lakhs Hong Kong dollar after 1 month, you need to have Hong Kong dollar in hand. But the point is, only after 1 month he need to sell. Tell me, children, whether he will buy Hong Kong dollar today itself, no use, because he has to keep the Hong Kong dollar for 1 month. The same problem arises, which means the dealer will also be exposed to foreign currency risk. Are you understanding what I am trying to say? Very simple. Today, the customer is selling dollar. The customer is selling dollar. Assume there is an export customer. He has received today dollar. The dollar he is selling to the dealer. The dealer, can he keep the dollar exposure open? No. If see, what is Forex chapter? What is you are trying to understand? Exchange risk. Now, if you have outstanding, receivable or payable, you are exposed to exchange rate risk. Correct? If you have foreign currency in hand, you are exposed to foreign exchange risk. Now, this foreign currency, if you transfer to the dealer, dealer will have that risk. Are you understanding? Assume you have a snake in hand, poisonous snake in hand, you will have the risk. What do? You give it to someone else. The snake, you pass on the snake to someone else. He will be bearing the risk. Are you understanding? He will also throw to someone. The cycle will continue, which means the dealer will try to cover his exposure. He is exposed to risk now. He will try to cover with the interbank. He will try to cover. In a Forex market, it is, chain market, which means there will be small dealer, there will be some bigger dealer, medium dealer, bigger dealer, like that the chain will continue. Are you understanding? So, he will go to the interbank market and he will cover the deal. How cover the deal happens? Here, assume he need to sell 100 lakh Hong Kong dollar, he need to sell 100 lakh Hong Kong dollar after 1 month. What do you do? Corresponding 1 month forward sell to customer. Here he does sale transaction to customer. He goes to the interbank market and 1 month forward buy he will do the dollar. Are you all understanding? Corresponding, okay, opposite transaction he will take in the interbank, and this is called as cover deal. Are you all understanding? Now, this will be sold how much in rupee terms? What is the sale value? okay, realizable value, and then you need to, okay, forward buy, now you need to pay rupee to buy dollar. Agreed? So here in terms of rupee, how much is the purchase cost, buy price or purchase cost, total purchase cost, this you will net it off and find the P&L. Are you all understanding? This you will find the profit or loss arising from the covered deal, corresponding opposite transaction. This we will find out through this question. Are you listening? Now see, you sold Hong Kong dollar. Now here this dealer, okay, has sold Hong Kong dollar to the customer, assume. See, this is customer side, this is interbank market. Okay, now customer side, like what he did, he sold, okay, 100 lakhs HKD, Hong Kong dollar, which means he need to buy Hong Kong dollar, correct? But the point, the value of this is how much? 100 lakh Hong Kong dollar he sold to a customer of 5.7, which means 5.7 into 100 lakhs, 570 lakhs. Agreed? This is in terms of rupee. 570 lakhs he sold. Now, to cover the deal, he has to purchase the corresponding Hong Kong dollar. Na? How much he would have paid in terms of rupees to cover the transaction? Okay, and then you will net it off and find the profit or loss. Shall we see? To find the to purchase a Hong Kong dollar, I have rupee in hand. This is a Indian based. Okay, by the question you can understand that this is the Indian based dealer, Indian dealer. Now he wants to buy Hong Kong dollar by paying Indian rupee. But the problem is here, okay, the US dollar, the Hong Kong dollar is quoted against US dollar and rupee is quoted against US dollar, but there is nothing with regards to, you know, Hong Kong dollar directly. How much Hong Kong, what you need to find? Rupee per Hong Kong dollar you need to find. Are you all understanding? Now the quotation, okay, dollar and Hong Kong dollar is given, which means Hong Kong dollar per, what is this? This is nothing but Hong Kong dollar per dollar, US dollar, given. And this is nothing but rupee per USD, given. Are you understanding? But there is no rupee per Hong Kong dollar. Now we need to find out cross rate. Rupee per Hong Kong dollar is nothing but common currency is what? US dollar is the common currency from this question. So rupee by Hong Kong dollar, you need to find out. Now see, common currency you will take as denominator, rupee by dollar into dollar by Hong Kong dollar. If you solve this, you will get the okay, you will get the rupee per Hong Kong dollar, quote for rupee, cross rate for rupee. Now here this is the equation, fine. But the problem is, in the previous question we directly took that 62.22 and 1 or 2 points of number. Na? Here the problem is bid rate and offer rate given, bid rate and offer rate given. Now where bid and offer rate is given and you have been asked to apply the cross rate, you need to okay, remember one thing, what we need, first you need to understand how the transaction flow is happening. Very simple. First, you need to buy Hong Kong dollar. What you have in hand, this dealer is Indian based dealer, he will have rupee in hand. So very simple, what he does, I'll tell you, he has rupee in hand. Agree? This rupee he will sell and buy dollar. Agreed? And he wants to buy Hong Kong dollar, but he cannot buy Hong Kong dollar directly because no quote is available. He will buy US dollar. Then he will sell US dollar and buy Hong Kong dollar. Are you all listening? So which means when I sell rupee and buy dollar, if I want to buy dollar, the quotation is given for dollar, na, direct quote in India. So which means this rate 42.7 I should consider, 42.87 you will consider. Very simple. You want to buy dollar or sell dollar? Buy dollar by selling rupee. Buy dollar, na. Okay, if you buy dollar, how much you need to pay? Higher rate, 42.85. Your higher dealer, interbank market, okay, their offer rate only you need to buy. This is the offer rate. Interbank offer rate is 42.85. You will consider where it is. Yes, this rate is 42. How much is that? 85. 42.85. Next, you have dollar in hand. You converted to dollar. You converted your rupees to dollar. Now you have dollar in hand. You will sell the dollar and buy. You need to buy Hong Kong dollar. Now, what rate you will use here also? You need to sell dollar. Sell dollar. Now this quotation Hong Kong dollar per US dollar. You will sell US dollar. And what? How much Hong Kong dollar will be paid to you? Only lower amount. Okay, this will be only paid. Okay, you are a dealer. will always pay you less when you sell and will always, ask you more when you try to buy the foreign currency. This is what happens. So Hong Kong bid rate will be used, interbank bid rate will be used, Hong Kong dollar 7.58 8 will be used. So 7.588 will be used. Are you listening? Like this you will convert. Now you tell me this is the rate you should apply. Now for substitute the equation. Equation you already did na. Rupee per Hong Kong dollar is nothing but what you need? Rupee per dollar into dollar by Hong Kong dollar. Agreed? Now tell me children, what will happen? Here rupee per dollar directly given? Yes, given. What rate you will use? This rate you will use. The offer rate you will use. That is, first you decide which rate should be used. You decide what is to be sold and bought, and you decide what rate to be considered. Bid rate, offer rate, you select it. Thereafter you fit into this equation and find out the appropriate cross rate. Are you listening? So rupee per dollar into dollar by Hong Kong dollar. Rupee per dollar, how much? 42.85. Rupee dollar per Hong Kong dollar given in the question. Hong Kong dollar by dollar given. Hong Kong dollar by dollar, which means into 1 by 7.588 you will do. How much is that? 42.85 divided by 7.5, 5.647 is the cross rate, which means this is for for every Hong Kong dollar, how much is the rupee? So 5.647 rupee per HKD is the rate to be, conversion rate to be used. Are you listening? Okay, next. Yes, this rate you will use to convert. Now, covered deal na. Now, see the solution, you will understand. Everything already discussed. Rupee dollar selling rate 42.85. Okay, pictorial representation also I gave. Dollar, Hong Kong dollar. Okay, Hong Kong dollar 7.880. This you will consider bid rate. Okay, and so cross rate is what? 42.85 divided by 7.5880. 5.6471 rounding off. Now, profit and loss to the bank. Very simple. Amount received from customer. 1 crore divided by 5.7. This I told na. See, find in the dealer account. Okay, dealer account. What happens with the customer with interbank market? Like this you can visualize. Here he has sold na. Okay, 5.7. Sold this much. 570 lakhs na I told you. Right? This is the value. 5.7. Here purchase price 560. Yes, this one. 564.7 lakhs. Now what is the difference? Please tell me. 570 lakhs minus 564.7, 5.3, okay, yes, 5.29, rounding off, no issues. Okay, this rounding off issue, 5 lakh 20, if you want to, okay, you solve in full. 570 lakhs minus 564.71 lakhs, you will get 5 lakh 20,000. This is the profit to the bank by this transaction. Are you all understanding this question? Very good question. Now you will understand question number 8 also easy. See. Take question number 8. You, a foreign exchange dealer of your bank, are informed that your bank has sold a TT on Copenhagen for Danish kroner 10 lakhs at the rate of Danish kroner 1 is equal to 6.515. You are required to cover the transaction either in London or New York market. The rates on that date are as under. Mumbai London rate given, and this is bid rate and offer rate. Mumbai New York, which means very simple. Mumbai London, this is rupee per pound. Like this you need to understand. Okay, rupee per pound. If per pound rupee is 74.3. Okay, 1 pound is equal to 74.3 rupees and 74.32 bid and offer rate. Mumbai New York rupee per dollar. How much is that? 49.25. And London Copenhagen. What is that? Very simple. London Copenhagen okay, DKK by pound, which means for every 1 pound 11.42 is the DKK amount. Are you understanding? New York Copenhagen, again DKK by Copenhagen dollar. Are you all understanding what I am trying to discuss? Okay, this you need to understand. This is the quote given. All these are various quotes given. Now you are required to cover the transaction either in London or New York market. Okay, now in which market you will cover the transaction? See, initially this dealer, this is also covered deal question. This dealer, okay, bank has sold DKK, which means this bank has sold DKK at this rate 6.5150, which means the dealer account I told you with customer, Okay, what happened? The customer, what is the amount? Na 10 lakhs Danish kroner, 10 lakhs, okay, into 6.515. How much is that? 65 lakhs 15,000. 65 lakhs 15,000 is the sale value. Are you all understanding? He has sold Danish kroner. The sale value in terms of Indian rupees is how much? 65 lakhs 15,000. Agreed? Now, he sold Danish kroner. He need to buy Danish kroner to cover the risk. Agreed? Now, Danish kroner he needs to cover. He needs to purchase using Indian rupee. Whether there is a quote given for Danish kroner in the market? No. Which means Danish kroner, here in this question, I can purchase to two route. I have two options. Very simple. I'll show you what happened. There are two options given in the question. Option 1, there is no directly you cannot purchase Danish kroner using Indian rupee. Correct? That you agree? Now you have Indian rupee in hand, this dollar. Now either you sell Indian rupee and buy dollar in the New York market and then sell dollar and convert this in Copenhagen market. Are you all understanding what I am trying to say? Upper rupee you sell and convert into dollar, dollar then you sell and convert into DKK, buy the DKK. Are you all understanding? By selling the dollar. This is option 1. Option number 2, which I have is, I have rupee in hand, I go to the London market and buy the pound instead of dollar, I buy the pound. Are you all listening? So I sell my rupee and buy the pound, then sell my pound and get the DKK. Sell my pound and get the Danish kroner. Are you all understanding? So there are two options available. What they are asking in the question is nothing but in which market you will cover the transaction, London or New York, which means London market also has Danish kroner quoted. New York market also has Danish kroner quoted, which means if you proceed under option 1, you need rupee per Danish kroner. That is fine. You can get either by entering in, okay, this is New York market. This is New York market. This is London market. Are you listening? So New York market, how will you do? You can form the equation common currency. You can take it as US dollar. Rupee per dollar into dollar by DKK. Either this you can do or option 2, if you go to London market, same rupee per DKK, okay, you can solve it by rupee. Common currency should be taken as pound. Rupee per pound into pound by DKK. This you can do. Are you all understanding? Both the methods is possible. What they are asking, solve using this and find what is the purchase value and find the net of and find the P&L. Solve under option 2 and net it off and find the P&L, whichever is the lowest purchase price or whichever is the highest profit, because we have sold DKK, you need to purchase DKK, whichever is giving you least inflow for purchase, least inflow in terms of rupees to purchase the DKK, okay, you will select that option. Are you understanding? Profound discussion. Clarity, are you understanding? Next, shall I proceed? Okay, now the issue, same way. The quote given, one-way quote or two-way quotes are two-way quote, which means bid rate also given, offer rate also given. I told you how to select quote. I already explained the previous question. Now I'll just explain the sense we will solve. Okay, I'm not going to explain again and again. I'm directly going to solve. Now, you tell me. First step in this you need to visualize. You have rupee in hand. You will, what do you say? You need to buy dollar. You need to buy dollar by selling rupee. Up a dollar buying rate, which rate you should consider? See, you should Mumbai, London, Mumbai, New York you will go. Rupee per dollar quote is given. So 49.25 you will consider, 49.25 you will consider, 49.26 you will consider. See, you need to buy dollar, which means higher amount you will pay to buy the dollar. 49.2625. 49.2625. Here, this is 49.2625. Agreed? This rate I am saying. Now, after converting into dollar, you will sell dollar and buy DKK. What rate you will consider? Please tell me, children. If you sell dollar in the DKK market, which means New York, Copenhagen market, I will go and sell dollar. How much you will realize? Bid rate only will be given. Lower rate will be given, which means 7.567. 7.567. 7.567. Are you all understanding this till now? Okay, under option 2. Now, option 2, if you go to sell rupee in pound market, how much pound you will purchase? You will get, see, Mumbai, London market I will go. I'll purchase pound, I'll pay money to buy pound. You are buying pound. When you are buying pound, how much you need to pay? 74.32. Bankers offer rate you need to pay 74.32. Where it is? Yes, 74.32. Are you all understanding? Now you will sell the pound. Again, you go to the London Copenhagen market, where it is London Copenhagen market, and you will purchase the Danish kroner by selling the pound. If you sell the pound, how much you will realize? Only less amount. Bid rate only will be given 11.42. Like this, you need to take every rate. The question, only thing covered is the one adjustment. Covered in, you need to know how it works. Then what rate you should consider? The bid rate and offer rate, the quotation, the basics of Forex, fundamental should be very strong. Okay, the entire chapter will become easy. Now, DKK, what is the rate I consider? 11.42. 11.42. See, 11.42. Now, you will find cross rate. Now, you simply apply this. Dollar per rupee. Okay, dollar per rupee, how much you will consider? 49.2625. Up 49.2625 into dollar per DKK given, DKK per dollar given, DKK per dollar given. Per dollar per DKK, how to find? Into 1 by 7 point, what is the number? 567. 567. How much is this number? 49.2625 divided by 7.567. 6.5101. 6.5101. This is nothing but rupee per dollar. Every DKK will fetch me. Okay, I mean, for buying every DKK, okay, buying DKK, now for every buying each DKK, you need to pay 6.5107 rupees. Are you understanding? Now, next to come to second option. This is as per first option. Second option, what will be the rate? Rupee per pound, you will consider how much is the rupee per pound? 74.32. 74.32 into, okay, pound per DKK. Pound per DKK 11.4. DKK per pound, DKK per pound is 11.42 given. What do you do? Into 1 by 11.42, which means effectively 74.32 divided by 11.42. How much is that? 6.5078. 6.5078 is the number. Are you all understanding? So this is the number, and now you have both the numbers. You will apply to 10 million. What was the transaction amount? How much DKK? 10 lakhs DKK. Upon 10 lakhs into, see, very simple, the solution you will find. This is the rate, na? See, cover at London. We have done option 2. They have put the option 2 as option 1. Covered at London, they have get 11.42. You convert the DKK. Okay, how much is the pound required? And then the pound is, okay, buy locally GBP for the above purchase, market selling rate of 74.32. See, ideally what they have done, to purchase DKK, you need to sell pound. How much pound you need to, see, market selling rate this much, which means locally he will buy this much pound to get it, sold. Which means pound, how much I need to buy. Okay, in order to sell these pound to get 10 lakh Danish kroner. 10 lakh, to get 10 lakh Danish kroner, I need to buy 87,567. Okay, with rates I explained here, in total amount they have considered and explained. Both are same. The rupee cost effectively will be 65,07,888. Very simple, na. This rate you got, na. This one, 6.5078 into 10 lakhs you apply, you will get 65 lakhs 800, rounding off 800, 880, what they have given, solution 880, rounding off it, no issue. Okay, this is a rounding. So profit, how to compute? 65 lakhs under option, London option. Okay, if you convert it to pound and make it, what will be the profit? 65 lakh 15,000, the sale value. Okay, DKK you sold. For purchasing DKK you invested 6507. Net gain is 7,169. Same way, New York market. Okay, this is the US dollar to be purchased to, get DKK this much, 10 lakhs. And to buy this much US dollar by paying rupees, you should use 49.26. Hence, okay, my rupee cost in terms of purchasing cost will be 65 lakhs 10,176. Net profit will be 4824. Tell me, children, both case profit, but which one will give me highest profit? Option number 1. So it is better to cover. The transaction will be covered through London market, which gets the maximum profit of 7199 or lower cost at London market by, yes, this is the cost will reduce by 2295, which means the profits, okay, 7199 minus 4824, which gives a 2295. Are you understanding the differential amount? This is the extra benefit you will get from this transactions. Are you understanding? Okay. Now, question number 9 we will discuss in the next video. Thank you.